Hi everyone, do you hear my voice? Do you hear me clearly? Okay, so I'd like first of all to welcome all of you. Thank you for joining us. This is Shadi Abdul. I'll be with you today to introduce a new webinar regarding the FX market. So today I'm going to cover all the basics regarding the FX market. This is considered to be like an introduction to the FX market. So the content of today, this is what you will learn on the webinar today. You are, and by the way, you are allowed anytime to ask questions during the webinar. So just leave a comment and answer you as soon as possible. So let's move to our content of today. This is what you will learn. What is Forex and some Forex terms that you must know. Let's put it this way, some definitions that will help you to understand the FX market very clearly. We also have a live we are live on YouTube as well, so you can leave your comment if you are watching us through YouTube. So we can simply answer you if you have any questions anytime. So first of all, this is the content of today. What is Forex? And Forex terms that you will use all the time, almost all the time in the FX market. The third thing that we're gonna learn is how to buy and sell, how profits and losses are made in the FX market, and the last part is practical part on the MT5, that is the platform that we're using, so we can execute our orders. We can place orders. We can simply read the charts and see what's happening in the market and read our market watch very easily. So to begin with, what is Forex? Forex is simply a word that consists of two parts. Okay, so originally it comes from foreign exchange. So the foreign exchange market is simply Forex. So from a linguistic point of view, I would say we have foreign exchange. So these two words, foreign exchange, that would simply make up what we call Forex. So foreign exchange as you can see, I'm not sure if you can see this clearly, but as you can see here, we have two words, foreign and exchange. So basically we have the first three letters of foreign and the first two letters of exchange. Together they make what we call Forex. So if we simply put them together, we're gonna have Forex, that is the FX market. In other words, we could also say FX market. This would simply express the same meaning, would deliver the same meaning. So Forex stands for foreign exchange, and it simply means trading one currency for another. For instance, if you are traveling to another country or something like this, let me see if you have any questions and see if everything is clear. Okay, nice. Okay, then it works. So if you are traveling to another country for any reason, maybe you want to spend some time, maybe you're traveling for visiting someone whom you love or something like this, then you can't really conduct payments there without exchanging money. You'll have first of all to exchange money, your own local currency with another of the other country that you're moving to. Uh, I mean, this almost happens everywhere around the world. Maybe in some cases, you can use your own currency in the country that you're traveling to, but in most cases, I would say you must exchange money so you are able to conduct payments. Other than this, you wouldn't be able to do so. So in this case, you will need to let's say acquire a certain amount of money so you are able to conduct payments. This is the reason why you are exchanging money. I mean, nothing other than this. But in some cases, as I told you, you will have to uh, exchange money so you are able to conduct payments. In other cases, maybe you want to do so because you want to invest. So there are many reasons, but let's put it this way: you are traveling to another country because you want to spend some time. So in this case, you want to conduct payments. In this case, you want to exchange. You want to acquire a certain amount of money or of the local currency of the country that you're moving to. So the conversions of, or maybe if you want to exchange the amount of money that you're having from your very own local country, the local currency that you're having, uh, this process simply means that you're exchanging money, so you are simply a participant in the FX market. Now, as I told you, the purpose or the reason you are doing so is not about making money, is not about that you want to invest or something like this. You're just moving to another country and you want to conduct payments. And in this case, all you want to do is to exchange, to acquire a certain amount of money, so you are able to make to conduct payments. So this is a very simple case, a very simple reason. Many of us would be moving all around the world every year or something like this. So you would be a participant in the FX market just in case you are exchanging, or maybe once you are exchanging your very own local currency into that of another country. Okay, so up until now, I think everything is clear. I would love to receive your questions if you have any time. Whether on YouTube or Zoom. Okay. So the reason you are doing so is not because you want to make money. Okay. So you are a participant. Think of it like this. Now you are moving to another country. You want to exchange money. You are a participant, right? Now you would do the same thing, but because you want to make money. So now it's not about traveling, it's all about making money. Now, this is why you are here today. You are here today because you want to make money. You want to learn. We are helping you. We're teaching you how you can make money from the FX market very easily. But actually, this is simply an introduction. So don't wait for too much. Don't expect too much today. We're just we're just starting our journey. Okay, so as I told you, it's not about traveling, it's all about making money. So some advantages of the FX market I would start with is that the FX market or the foreign exchange market or the Forex market, call it whatever that you want, is simply the biggest and most liquid market, reaching daily volumes of over $5 trillion every day. This happens every day, 5 days a week. So this is simply unlike other markets. There is no central marketplace as well, and currency trading is done over the counter. There is something that is called OTC OTC that we have here, which means decentralization. There is no a certain building or place where orders are executed. No, actually, it doesn't go this way. There is no central place for the FX market, which makes it very easy. Anyone can participate in the FX market. Maybe many years ago, the stocks market, if you want to maybe buy something or sell something, you would um, use your phone, call someone to do this for you, and like and this would happen during like certain hours or something like this. So um, this is simply how it goes. But the FX market makes it very easy, or maybe the disadvantage, the decentralization of the FX market enables the spot currency market to remain open 24 hours per day, closing only during the weekends, and this simply makes it very easy for all of us to trade in the FX market. Makes it very easy. So we have from I mean the operating hours would be from Monday to, or days from Monday 24 hours to Friday, so 5 days a week. Weekends we have Saturday and Sundays. So I'm talking about the time zone that is plus 2 GMT. Okay, so in this case, you have a very um, huge amount of time where you can, maybe you can adjust yourself. You are a worker or whatever. You are a student. You are a teacher. Whatever, you can find a good or a suitable time for yourself so that you can trade. Okay. Do you have any questions on this before I carry on, guys? Questions? Okay. Okay. So as for the terms, now I'm done with the definition of the FX market from a linguistical point of view, and the definition itself, how it works in the FX market and what the FX market is all about. It's all about exchanging money, um, so that so that you are able to make money. Nice. The first term, let's move to something else. Forex terms that you must know. So first of all, we have currency pairs. This is the first term that we're facing, that we're having today, is that is very important. So currency pairs is simply what it's all about. Each world nation has its own currency. So if you want to trade a currency of a certain or a specific nation, this means that you would exchange it with another one. So we have two currencies. In this case, we have a currency pair, right? So each world nation currency trades in pairs with another. Okay, that is why they are known as currency pair. Each of the pairs consists of one base currency and one counter currency that's also called quote currency. So in this case, look at this. We have here, for instance, euro, and we have USD. So we have two currencies, right? The first one is simply base currency. We would never change it. So it has its place, it has its order, so it would never change. So the first one is always base currency. The second one is quote currency. So the euro is quoted in US dollar. Okay, so this is how it works when we have a currency pair. This also goes for GBP USD, USD CHF, USD JPY, anything else. anything else that consists of two currencies, we would have the first part as our base currency and the second part as our quote or quotation, sorry, quote currency. Nice. Um, okay, so let's continue. As you can see here, I mean, this is for me today. I would say this is the most important part. Why? Because it's all about currency pairs. It's all about these pairs, currencies against one currency against another, one nation against another. So we want to know what's going to happen. For instance, for the euro against the American dollar, is the euro gaining value against is it gaining value against the American dollar? So in other words, the US dollar is losing is losing too much value. So we want to know how it works, so we are able to take advantage or of whatever that's happening in the market. Clear? So um, this is what a currency pair is. So maybe we can go to our platform to see how it works. The platform is simply a software that you can download on your PC. Maybe you can use your um, browser, so you are able to uh, use the platform. Maybe if you have an iPhone or whatever, an Android device, whatever, you can also um, use the platform. Nothing wrong with this. Okay, here is the platform. Not sure if you can see this. Just a minute. Okay, there you go. This is the platform, the MetaTrader 5. And here is where you can watch the market. We have here market watch, uh, everything that could be everything could be found here regarding the FX pairs and so on. We have majors like Euro USD, JPUSD, anything that has the US dollar as a part of it. We also have like indices. We have um, gold. We have silver metals. So we have CFDs. So many things that you can simply watch, many things that you can trade, many things that you can analyze. I mean, you can just open the chart and you can start trading right away. Nothing wrong with this. Everything takes just a few minutes, so you are able to go. Okay. So in this case, let's go back to our presentation and see what we have. Okay. Then we have a nice term that is called PEP. Here is an example, but let me explain first of all what a PEP is. In Forex trading, the movement and prices of a currency of currency pairs is measured in pips. The movement that is happening in all currency pairs is measured in pips. A pip is simply a shortcut for the phrase percentage in point. So we have here, for instance, 1.2351, 1.2351. Nice. Now, this is the fourth decimal number is called pip. So this is maybe the third one is called. So we're going to read the number 51 pips. So from this point, 351 pips, and so on and so forth. But if we have a fifth number, this is not a pip. This is simply a part of one pip. Let's say that a pip is like 10 parts. So the fifth number is simply one part of 10 parts. So in this case, as you can see, we have 1.2351. The fourth number is a pip. The third is 51 pips. The second is 351 pips. The first number after the decimal point is simply the first decimal number is 2,351 pips. You know what I'm saying? Okay. So do you have any questions on this before I carry on? Okay, so let's carry on. So this is the smallest price change when it comes to the first, when it comes to the fourth number. Okay, there is something that is smaller than this. That is the fifth number. Okay, the fifth decimal number. Okay. Um, so okay. So again, this is the smallest. I mean, let's put it this way. When it comes to the first four numbers, this is the smallest movement that can happen in the market. Okay, that a currency pair can make. So, for instance, we have here GBP/USD that is 1.2350 raised to 1.2351. So that is simply 1 point. That is simply 1 point. Value is based on lot size, and this is the next the next term that we're gonna explain. Now, maybe you want to ask me what is the value of this one pip? Is this money? Is this real money that I can touch in my hand? Well, actually, no. 1.2351. So 0.0001 is a very small number that you can't really touch. So in order to be able to take advantage of this very small movement, you must use a huge amount of currency, so you can touch this small movement. You know what I'm saying? So, for instance, if you want to know the value of this 0.0001, you must simply use this calculation. Just a minute, I'm going to show you this in a minute. Okay, so look at this. If you are trading like $1,000 or whatever, okay, 0.0001, look at this. This is 0.1, 10 cents, 10 cents, okay? So in this case, you know that if you're trading 1,000, this very small movement is simply 10 cents. So What about if I'm trading like, for instance, 10,000? Okay, this is $1. Okay, what about if I'm trading this amount, 100,000, $10? So it depends on the lot size that you're using, the amount that you're trading. The pip value is a pip is a pip, so you can't simply change it. But it all depends on what? It depends on the lot size itself. You know what I'm saying? Okay, so let's move to, let's go back to our presentation. Now we have here the lot size. The lot size. The lot size is simply, it starts from 1,000. Starts from 1,000. This does not mean that this is the amount that you're gonna trade. No, it has nothing to do with the amount that you're gonna trade. This is the amount that you would simply be trading in the FX market by using what we call leverage and margin trading. This is a system that I will explain later. Nice. So how does it work? What is a lot size? I mean, guys, all the time we are trading, we are buying and selling things in units. Okay. And when it comes to currencies, currencies have always been traded in specific amounts that are called lots. The standard size for a lot is 100,000. There are also many lots of 10,000, and we also have a micro lot of 1,000. Why we are doing so? Why we are trading these amounts, these huge amounts? Because we want to take advantage of the small moves in the exchange rates of any currency. So in this case, we need to trade large amounts in order to see any significant profit or the opposite or loss. So this is simply how it works. So this is simply the lot size. If we go to the platform, we're going to see this clearly, because the platform would simply give you this option. If you go to new order here, you're going to find here volume. The volume is all about the lot size. For instance, if I want to trade 1,000, so I'm going to write here in volume 0.01. This is 1,000. See, this is 1,000. If I want to trade 2,000, so 0.02. So it starts from 1,000, then 2,000, 3,000. Here, we don't have nothing less than 1,000 if you want to trade, okay? This has nothing to do with your initial deposit. You can trade with $500, nothing wrong with this. But I'm talking about the amount that you want to trade using leverage and margin trading. You know what I'm saying? So in this case, the volume here is going to be 0.01. We start from 0.01, then maybe we can go like 0.10. So this is going to be 10,000. We can go 0.50. This is going to be 50,000. We can go like 1, and 1 simply here means 100,000. We can go 2, nothing wrong. So 200,000 and so on and so forth. So this is simply how it works. One more advantage of the many advantages that we have in the FX market is that you can simply limit your losses or your profits. For instance, maybe you are not in front of your PC, or maybe you are busy or doing something, you're playing, you're doing your work or whatever, you're traveling, and you don't have time right now to look at the chart or to see what's happening in the market. So beforehand, you can simply set a stop loss and a take profit. So if the market goes against you, this can simply protect your your account. So for instance, I'm gonna tell the platform, hey, platform, please, if the market goes against me, like against me with this amount, like if I'm gonna lose like $100, $100 or whatever, then please close this position right now. I don't want to continue. Or maybe if I want to save my profit, uh, okay, the platform, please, if the market goes in my favor, like $500 or whatever, then please close this position. I don't have to be in front of my PC or maybe using my phone or whatever, so I can close them. I don't have time to do so. Please do this for me. The platform would do this automatically based on your orders. You know what I'm saying? So this is a very important thing, a very, very, very nice advantage of the FX market that you can simply use. Okay. Uh, so let's go back to our presentation and see what we have. Okay, so this is simply the lot size. We also have two terms, bid and ask prices. What is bid and what is ask? Bid simply a word that stands for the best possible price at which a given instrument being traded at the present moment can be purchased by a trader. So you can purchase a currency pair at this price. Okay, so how it works? You can simply sell, because in this case, this is the bid price, which means the sell price. Sorry for this. So in Forex trading, bid price simply refers to the highest price which the broker is willing to pay in order to purchase the instrument from the trader. Okay, so this is how it works. The ask price is simply the opposite. It stands for the best possible price at which a given instrument being traded at the present moment can be sold by a trader. So in Forex trading, ask price refers to the lowest price at which the broker is willing to sell the instrument to the trader. Okay, so this is simply how it works. Okay, Asig. So let's put it this way, in a very simple way. The bid price, the price. Okay, let me share with you the platform so we can explain everything clearly. So here, look at this. We have two prices, bid and ask, right? Nice. So we have bid and ask prices. The bid price is the price at which you can sell. The buy price is the price at which you can buy. That's it. Okay. Now, as you can see, there is a difference between them. The difference between them is simply called spread. And this is simply the commission of the broker. The commission of the broker in each trade that you want to enter. So this is simply, maybe we can see this is, we can say this is the fee or the commission, which any broker will charge you every time you enter a trade. And it's a very, very important term. It is simply the difference between ask and bid prices. You know what I'm saying? Now let's move to something else. Leverage. Something else that is called leverage. So guys, leverage is simply a very nice advantage, a very nice tool, which allows traders to enter markets that would be otherwise restricted based on their account size. So it all depends on your account size. If you have no leverage, leverage can simply delete the fact that you are restricted to the amount of money that you're having in your account. Now, with leverage, there is no problem. Leverage simply allows traders to open positions for more lots, more than what you can do with your own real money. So it will help you to enter trades more than what you can afford, more than what you have in your real account. This is what leverage. This is how it works. We also have another term that is called margin. Margin is simply related to leverage. Margin is related to leverage. Why? Margin simply helps you to gain access to funds. Let's put it this way, and maybe explain another way that can be much easier. Now, I told you before that we need leverage so that we are able to trade more than what we have. Now, to gain access to these funds or these amounts that you are not able to afford, the brokers will ask you to put down like a good faith deposit of, say, like 1,000 or maybe 600, which they will hold but not keep. They would simply hold but not keep. This is what we call our margin. For each position and instrument we open, our broker will specify a required margin indicated as a percentage. Margin can simply, therefore, be considered a form of like, I mean, we could call it like a short-term loan we take from our broker along with the actual instrument itself. After we make profit, we give them back their instruments, and we at the same time they would give us back our margin, our the good faith deposit. Okay, this is how it works. Now, this is your money. Thank you for helping me. I don't need this right now, and I'm able to trade. I was able to make money, or maybe you might lose money. Just keep this in mind. You might lose money as well. Keep this in mind. This is very important. So it's not only about making money, it's also about losing money. Okay. So this is how it works. Margin is all about, maybe if you have a leverage of 1. Now let me help you to read these numbers. A leverage of 1 to 50 means 2% as a good faith deposit. The broker would ask you. 1 to 100 means 1% as a good faith deposit. 1 to 200 means 0.5% of your 0.5% as a good faith deposit as well. 1 to 500, 0.25%. 1 to 500, 0.20% of the, 2% or 1% or 0.5 or whatever of the lot size that you want to trade. So if this is going to be like 100,000, 1% means you must afford as a good faith deposit like 1,000. So if it's going to be 1 to 200, this is going to be 0.5. This, so if you're trading like 100,000 lot size, this means 500. 1.4, 1 to 400, this means 0.25. So $250, $250, 1 to 500, this means $200 can open the trade. Okay. So this is simply, guys, how it works. Maybe next webinar, we can use some practical examples on MetaTrader 5, but maybe next time. So that's it for today, guys. I hope that you have enjoyed the webinar today. Thanks for joining us. Thanks for being there, guys. Stay tuned for our upcoming webinar, and bye for now.